So sorry, but this is the beauty of being live for the first time. And today, being our first live, of course, we are trying a little bit the setup. So what I wanted to do today really is to introduce our new LinkedIn Live series. The idea is to have a weekly meeting. In this weekly meeting, we will discuss the latest news about private equity, capital markets, private debt, and kind of cover a little bit what is the latest industry update. And usually we are going to do this with a guest speaker. So the idea is to have guest speakers from the industry that are either involved with LPGP, Impact Fundry, or any other professional that is part of our network in the industry. Of course, the call is open. If any one of you attending today from the private equity sector believes they can contribute to our weekly meeting, by all means, reach out to me by email. Is amc@impactfundry.co. I will share my email address. And you can of course reach out and have a chat with us, and then we can figure out if is the case for us to involve in our um, in our initiative. Today, I would like to, of course, discuss about the latest topics. We picked from the news whatever is relevant in the market right now. Just for context, we thought about giving it a name. The name of this LinkedIn Live is going to be Inside Private Capital. I know it's not not very like there is not too much creativity, but of course we try and keep it in context. And as I said before, the idea is there to break down what's happening in the world of private equity, private debt, and make sense also of the mechanics behind the headlines. A little bit about me. My name is Andrea Cosentino. I am the founder of Impact Fundry and Kognitiv Academy. I come from a banking and finance background. I spent more than a decade in the industry. And I do, of course, understand the technological part as well. Together with LPGP, we decided to partner up and, of course, run these as well as many other initiatives together. So if you are one of those people, sponsors that attend our events, you will probably see us every time you're kind of walking around, and probably you will see me come and pick you up to record a podcast that will come out very soon. Together with LPGP, always we are working really hard to bring more content to the industry. The idea is for us to run these live webinars in pair with all the other activities we're doing. And in 30 minutes, the idea is to walk you through the biggest news stories of the week, not just what happened, but also why it matters to you. And of course, try and connect the dots between the market trends, some practical advice for GPs and LPs, go through regulatory changes, and of course, understand kind of how this impacts you. Now you see that there is a presentation up. It's not just kind of to show our logos, but there is usually three or four frameworks, which will kind of complement what we discuss, and essentially these will kind of support visually what we're trying to convey to you as a message. We will mix charts, potentially frameworks, like anything that can be useful for you to understand a little bit better what the industry is bringing. And of course, by all means, try and send us questions. I do believe there is a chat around this LinkedIn Live. So if there is a chat, try and chat and send some questions if you have. And of course, I will do my best to juggle between answering you and providing some context. So the first topic I wanted to talk to you about today, it is very much, I will switch into it is very much about the trend of surge in deal value. This is kind of the main topic, really, how I named the event, because I think it's very interesting. There is an S&P Global article. And by the way, at the end of the event, we will send out and we'll post on our websites all the relevant data. So, link to the article I mentioned, a wrap up, kind of an executive summary of what I discussed, but also these frameworks that you see. So the first part I was saying, there is an S&P, the first article that we picked is an S&P Global article that discusses about the value of private equity that in first half of 2025 surged about 19%. Now, what is interesting to see is that there is not just a surge in the value, but also there is a counter trend in the amount of deals that are closed. So apparently, what we see in the market right now is that there is less deals, but of a bigger value. This is, of course, very, very interesting. I guess it can be interpreted in two ways. It's either a new wave of mega deals or just a simple recalibration. Of course, the pace of interest rate and inflation that we've seen in the market did play a role in this. I think another probably a very important trend, considering that private equity invests for the long run usually, is that we are living a dry powder pressure moment. Why is that? Because many PE firms in 2021, 2022 just exposed the COVID, but also in a place where interest rates were very low, very convenient, they raised large funds. Of course, with inflation, interest rate hikes, 2023, 2024, I mean, especially here in the UK, we felt it a lot. These deployments loads. And now in 2025, of course, these GPs are in pressure to deploy the capital. There's kind of been steady in their pockets, I would say. And this, of course, led to probably less deals, but larger. Why less? Because, of course, thinking that there is a lot of money to move, we might think, well, why not more deals, right? Well, the thing is that in order to achieve quality deals, right, there is certain, as you all know very well, there is certain criteria to be followed, right? For example, matching a very interesting IRR, or anything else that kind of matches the risk profile of the company or the industry, for example, right? So in this context, of course, fewer targets apparently met the scale and the kind of quality expectations of the firm. So of course, these firms are trying to pull capital together in order to invest into higher conviction kind of platform style acquisition. So you wouldn't be surprised to see more club deals and more kind of firm joining forces to actually attack those very interesting deals that are out there. So can this be seen as a kind of consolidation? Not sure about that, but for sure there is more focus on quality than quantity, and this is a clear message that comes from this type of information. Of course, even in terms of valuations, there has been a bit more of a more rational approach. Again, we're coming from a place where at some point valuations were really skyrocketing. Myself, even though I'm involved in the private equity space, I work a lot more with venture capital. And, being VC part of the PE umbrella, I can tell you that from personal experience, there was a moment a couple of years ago where the valuation of startups was simply like nonsense. And I think also we're coming from that wave where there is so much more, kind of so much more mindfulness around the valuations that are given to specific businesses. Of course, the drivers that we see, as I highlight in this framework, we have four main drivers: inflation, interest rates. I mentioned regulatory shifts. I'm going to talk about it in a minute because there is an important update from the US. Of course, the fundraising environment, which I have mentioned, and the tech disruption that we do see all around. This is, of course, the kind of first part that I wanted to discuss. But if you give me a minute, I think we have a guest with us, and just bear with me. The second part, I think, the second news that we picked comes from Reuters, and is about the state antitrust enforcement in the US targeting private equity in healthcare. This is interesting. Why? Because there is an increased state level antitrust regulation that came in place, where essentially states like Oregon, for example, and Connecticut require private equity firm to submit acquisition notices for healthcare deals. Now, we know the healthcare has always been at the focus of private equity. Like some of the most beautiful deals are done and were done in the healthcare space. This, of course, was before a federal matter, and now we have even the antitrust jumping in. Now, why is this important to know? Because, of course, as the regulation raises, we do have a situation where we have new regulatory filings, so a lot of admin. We have new delays, we have more costs, okay, and there is a multi-jurisdictional friction that is created. So of course there is a whole impact in the process, in the timeliness, more due diligence, raising, the risks there are that come from the public screening or anything else. So this is kind of going to have very strong impact in the operativity of the deals as we face them. But I take a minute because I think Vinay is with us. Hello, Vinay.
Hi, Andrea. I'm sorry I had a technical challenge in getting to the meeting room. So thank you so much, everyone. Sorry for the delay. Yeah, we can get started.
So yeah, we did start. We went through the first two articles. I was just discussing about the antitrust the antitrust for healthcare,
Hmm.
and I would love to hear your comments. I do have to say I have a bit of a challenge because I hear my back, so I
Hmm.
hear my feedback, so I'm kind of listening to me twice, and I want to fix that. But why was to fix that? You don't introduce yourself to the audience.
Sure. This is Vinay Bantu. I run an economic intelligence firm in Washington, D.C. called Global Economist, and I also have a background in investment management. I run an investment management company in New York, which is YMY Capital. I am an active speaker with LPGP Connect for a lot of events since years. So I definitely look forward to answer the certain questions that have been framed towards accelerating the PE and its cycle and how the trends are going to change in the next few years based on both macro as well as the operational excellence of the funds.
Amazing. Thank you very much. I fixed my audio issue in the meantime, so thank you very much because you helped me buy in time a little bit. So, just for context, look, we discussed, of course, me and you agreed prior to this conversation on the articles we're gonna talk about. I had time to discuss the surge in the deals value, 19% as per S&P article. I was getting more into the state level antitrust involvement for PD for healthcare PE deals. I guess I was giving my 2 cents really, especially on the first one on why we see maybe less deals with a higher value. I guess if you can give us a wrap up of what you think about these two trends, and then we can deep dive into the rest of the content.
Definitely. There has been a lot of momentum shift within the deal count versus the deal value. So, and the main trigger for that from a private equity standpoint is the M&A activity. That's why, you see the lesser deals with more value. The deal count is less and there is more deal value. And M&A drives that particular diverse sectors actually. If you look at healthcare, if you look at the recent merger and acquisition activity that is happening across the globe, and due to that macroeconomic uncertainty as well as the stability, that is the main reason the deal values of the investors are resilient, and also they are confident in this. And that's why the structuring of those deals are happening more from an M&A perspective with larger and larger. Whenever there is an M&A transaction, definitely it's a high valuation deal. The pipeline is definitely strong. And as they are in the moment of realization, if it's already an existing deal that is going to be tapped in, so definitely those are the M&A pushes that you see. And those are the large transactions that are happening. Whether it was Twitter, whether it was any other deals that are happening in the past, it's all through that deal count versus deal value. And if that particular portfolio company is already there, I think the perspective of that macro effect on the trade, on the overall commerce as well as the political shift, that is what is changing the deal count versus deal value.
That's fair enough. Now, again, just to speed up a little bit on what we touched, but if we now look at I picked on the Reuters article, which says state antitrust enforcement targets PE in healthcare. Now, of course, this I was trying to explain. This brings, a lot of inefficiencies, I guess, if you want to put it down that way, right? Because there is more operational burden, there is more regulation. Like, what do you see happening here? Because, for example, from my perspective, I do see definitely costs and, as I said, burden of running deals in this space is gonna raise, which is not a good thing for the funds. On the other hand, it could be actually taking away a lot of funds from the healthcare into other sectors that probably are not, that they're not as scrutinized as the healthcare one. What is your vision here?
So actually, the healthcare value chain itself, it starts with clinical trial to disruption, and where you see the entire engagement from a provider standpoint, from a patient standpoint, from a technology standpoint. So the the key effects that are driving this antitrust thing is restriction or enablement of the regulatory shift itself. It's on sometimes there is sometimes there is a clear restriction on M&A activity in bigger markets in this space, because you can't have the insurance provider be the same guy who's doing all the other value chain things in a entire sector. So that is a really a key driver where we see that regulation restriction or enablement, and that's what drives the deals. If there is an enablement happening within that region or the sector, you will see most of the deals happening faster, quicker. If there is a restriction coming from both on the regulatory side, from a compliance side, especially you see those more on the insurance side, healthcare insurance side, because it is not only just having companies merge, but it is the data that's being managed by those companies and what kind of accountability and transparency that these companies should maintain, and at the same time how those mergers would affect the other people in the value chain, whether it's small companies or large companies. So that is where the antitrust comes into play, and it is very laser focused on right now on AI, how you manage your data, and at the same time the DEI, diversity, equity, and inclusion. All those other areas also come in, and that's where the regulatory enablement happens. And if there needs to be a restriction, definitely there will be a restriction based on those conditional effects. So, for example, if you look at a macro level, the economic conflicts are allowing not to invest into companies that have certain origin of the funds, basically. So that enablement versus restriction is predominantly driven by which part of the value chain is being either for merger or an acquisition opportunity, and that needs to be clearly assessed, not only from a current state standpoint, but at least from a future state standpoint. How does this merger happens? For example, if you look at AT&T's deals that happen, they went into Dish Network and they did all of the media acquisitions possibly they could, but financially there was some challenges as well. They have to divest those deals. So whenever there is a regulatory effect, you will clearly see the deals happening from a PE standpoint, both from investment versus divestment. And that is what the key is for restriction versus enablement. When there is a divestment happens, then definitely you are working in a restricted environment.
That's fair enough. That's fair enough. Thank you, Vinay. Moving into maybe a bit of a different topic, focusing more on the retail. There has been an order from Donald Trump, as the Wall Street Journal reports, where he wanted to expand 401k access to private markets, right? Now, this is contrary maybe to the previous one. This is probably a good news because it means opening a good chunk, right, of a more publicly available market. I guess the question, from my perspective, is what does that mean for retail investors, and is this essentially going to democratize private equity for everyone? What do you think?
Private equity is a very solid product when it comes to return. So here is the big challenge here in this is risk versus return, right? What is that risk that market will inherit? What is the risk that investor will inherit in this scenario? And I think where the current proposition, if you look at any of the pension funds, they come with a lot of risk. Basically, they have a very holistic risk management that looks at the underlying risk of the asset, it looks at the underlying risk of the market, it looks at the credit. So the risk itself, the risk spectrum and the definition when it comes to the pension funds or 401k, that is too high. And the appetite to even start bringing from a retail investor standpoint is where, first of all, there is no certain that kind of a return that is comes with that kind of capital available for retail investors at this point, unless until that particular PE fund is they have some public shares and stuff like that. So the mobility to go into those kind of uh, transactions, it's all based on risk versus return and how that risk versus return entails the mobility within the market and the credit. And that is where I think most of the challenges that retail investors have is they look for these deals to invest, and through these options and channels with regulatory help. For example, if you look at Tesla, Elon Musk is into all the sectors. Actually, he's into energy, he's into transportation, he's into telecom. But at this point, none of those enterprises have those consumer markets. So people go ahead and invest in Tesla. So that is the identity factor. Today, I could see Elon Musk directly from Tesla and I go invest in. So retail investors will not be able to engage in activities where, hey, this is where I would go with this deal. They will have a decent return range coming into it, and they will also have to increase their appetite on the return as well as understanding the risk management of that entire spectrum. And that is where I think um, the asset management would come into play and the investment advisory would come into play as it eases into go into those products.
Yeah, look, I definitely agree like with everything that you say. And we've seen in European markets, I think there is an example we have actually in Italy, Azimuth Capital. They have created one of the very first fund of funds that was essentially giving access to retail people, to private equity performance. There is definitely an appetite there. Um, my question is, doesn't this though bring structural complexity to the current operations? Because by the moment private equity companies want to direct attack these markets, then they have to get into, providing daily liquidity, NAV, free transparency. Like there is a lot of kind of public market work to do. They're not really set up for, right? Because that's why it's called private market. So, don't you think this is gonna be very expensive to get into for the funds?
Definitely, because if you look at the transactions that a private equity really works on, is you have the equity, which is majority or minority into a portfolio company, number one. Number two is either merger and acquisition, right? So when you are setting up these funds, private equity funds, there are different ways an investor comes into mobility standpoint. It could be co-investment, it could be direct investment. So if you look from an investor journey, your entry and your exit on that transaction is very important. So that is where most of the large private equity companies, they also sell their shares through public, basically. So you can directly go and participate into the value creation of that particular private equity fund if they are a public listed company or if they are already in a particular market. So that's what the entry and the exit is a big challenge here for investor, and the private equity manages that very well. And again, you have to look at the entire pieces of the segment of the investors. It's not only just retail investors. If you look at the larger scale, you have pension funds, you have celebrities, you have all those other high net worth individuals and stuff. So setting up that structure with an entry and an exit, and from a valuation standpoint and a possible continual dividend, that's what the private equity model is. And to structure all of that and open it to the retail investors, definitely there will be challenges and it will not happen overnight. It has to come in and show that result. Definitely private equity fund has a guaranteed dividend coming into play, whether it's 6 to 12%, or a management fee would be you know under a 2% if there is a larger deal. But I think to to even continue that process of opening it up, it will take some time, and that is all based on the structuring of a fund, and that would come with an extra cost on the legal providers, which could be setting up an offshore fund or a parallel fund or a feeder fund, and all those areas are also a challenge. So I think the fastest way, the current way, is go invest. If that particular private equity fund is already listed in a stock market, go buy the stock. So you make money there.
Enough, fair enough. You
Yeah.
mentioned a lot of risk and return. I just wanted to pick up on another piece of information. So earlier this month, we heard that Apollo Global Management, which we do know very well here, especially LPGP, they got a 5.7 billion takeover of Pension Insurance Corporation, which is essentially a UK-based retirement saving group. Now, if we think about the next 10 years, British companies are expected to kind of offload about 400 million, sorry, 400 billion in terms of retirement obligations. And of course, there is a whole set of assets, right, that backs them via risk transfer agreements, and so on. Now, my question to you is, how is this pace changing, and how is it shaping, reshaping the expectation exactly around this risk and return in the long term for the investor journey?
Yeah, definitely. If you look at Apollo Global, you have to look at that the spread of the products that they deal with as a fund. So most of the Apollo's transactions are private credit. So that is where they are very, very known for in the market. And if you look at KKR or whoever the other competitors is, which ones got that private equity versus private credit or private debt and all those. So the financial products in general is equity, debt, credit, and derivative. And how do the investor get into it, into that fund, is what defines the relationship between the LP and the GP, basically. Because if you're looking at a credit and a debt fund, definitely your specifics and your entries and exits are different, because those funds could be open end versus close end funds, right? You could raise the money all time, and or you can, most of the private equity funds are a closed end fund, because you have a clear entry and a clear exit, because you have to maintain the valuation at the exit, right? So from that standpoint, a pension fund, actively works on all the segments of investors. Basically, most of the larger investor group is also insurance companies, in this scenarios. So as they come in and start deploying that allocation, the risk gets diversified, but at the same time, the return gets minimized also. So the more you diversify the portfolio, the less the return is. Because if you look at any investment into equity product, directly people go into domestic equities or the international equities, and that is where you see your alpha coming into play. Now, setting up a multi-market, multi-asset portfolio, or even a multi-fund, where you can see there are portfolio companies that are on the innovation side. If you look at ARC Investment as a investment management company, most of the allocations are into disruptive innovation, the portfolio companies. So
Yeah,
definitely, it is, if you could define what fund they have, it is, it behaves like a VC, but it gives you a return more than anybody else sometimes, and it also has the larger risk, right?
yeah.
So it is, that's how this whole allocation changes when it comes to pension fund, because they seek uh, risk management from a different perspective. They would like to see multi-market, multi-asset, and multi fund as well, multi-return as well, in terms of how the fund behaves. So it's quite a challenging to construct a portfolio that has a multi-asset. When I say multi-asset, because the PE funds, what bring to the table is the dividend on time, which comes from the operating income. And that operating income needs to be sustainable until there is an exit date, which could be which could be 5 years, 7 years, 10 years, and you can extend it based on how your portfolio company's valuations are. So that is where the entry and the exit. When it comes to Apollo, they do huge transactions because their deal size, their fund size is larger, the deal size is charger is a bigger number, And at the same time, the deal counts go so fast because they tap into different industries, different sectors, and they switch gears between equity and credit. That is the key, the growth of Apollo at this point.
I think everything that you said, of course, it does make sense, and it leans, kind of paves the way to me for me to move into the next topic, which is the fund cycle, right? As you see, I'm sharing the frameworks that we built to prepare for today's LinkedIn Live, and I want to pick up on both what we said at the very beginning in terms of kind of stolen money in the amount as Reuters reports of 1 trillion, and looking at the PwC private equity deal outlook for 2025, there is clearly a longer holding time. The LBO financing became more expensive. There is a mismatch between what the GP wants in terms of prices. They want to pay 2021 prices, and what the buyers want. They want 2023 discounts. So clearly there is a mismatch between, who wants to buy, who wants to sell, and they kind of, looking for exit alternatives right now. So we see more continuation funds. We see assets rolling over into new kind of vehicles. I mean, I guess my question is, what type of environment, right, are we getting in? Are the mechanics that usually drive the fund cycle and the fund management changing, or permanently? Is just a period like? Well, how do you see this dynamic evolving in the next 3 to 5 years?
Yeah, definitely this cycle does explain that process. Now, is it parallel or, is it sequential? That's a question, right? So
Mm,
if we go from a sequential standpoint, the first thing is deal sourcing. So how do you source a deal? Basically, every fund has a deal pipeline, right? So within that deal pipeline, first thing that they look at is the what is the success criteria of that deal, basically. If you look at anything that's listed with SEC or any other filings, the public filings of a company, the first thing that they would look at, even Wikipedia, right? What's the net asset value here? Total
mm,
assets. Okay, number one. And the second thing is, what is the revenue? And the revenue becomes more interesting as the company is diverse and integrated with sectors and markets, basically. For example, if you look at the large giants, in a particular sector, they will be doing, for example, Jeff Bezos, Amazon. That's the best way. There's a Washington Post portfolio. There is a which is into media and stuff. There is commerce activity going on and logistics activity going on. And Amazon, there is a AWS, right? Definitely companies like that, which has an integrated sector value, their stock price would be more and their valuation would be more. So when you source a deal for PE usually comes at a middle stage to later stage transition of companies, which that's the best time to get in. But they also, because of the term of the fund, they also stick beyond the IPOs, beyond the later stage as well. So because usually the mutual funds do come in on the 5 to 10% investment allocation as the company becomes larger in valuation and grows. So there is a certain areas that PE comes into play on understanding that deal source, deal value or deal volume and deal pipeline and the deal criteria. Now, criteria, as I said, first thing is when you look at a company, first thing, is it an early stage, middle stage, later stage? PE only focuses on middle stage and later stage, which is above a billion in value. And their minimum tickets would be anywhere between, the minority tickets would be anywhere between 25 to 200, 300, or if it is a majority equity, it would go more than $1 billion. So, and in that deal, you have to look at the markets. Is it global? It's domestic, it's national, it's regional. And the second part you look at that deal is what revenue range and revenue types coming from different markets. It could be business to business. If it's Ford is selling the cars, it directly sells it to the US government. It's a business to business deal. If you're selling it to business to consumer, you're selling it directly to the customer. It could be business to employee as well. So when they look at that range, they look at all of those um, different levels of revenues that are coming in, consumer to consumer as well. Most of the online platforms that they bring in, That is how the deal is structured based on the success criteria, the revenue range, and the market type, and also the valuation plays in a major role, because if you do a merger and activity, automatically your stock price is going to change on your capital market, and your consumer market, your products and services will also change. When airlines merge together, there is quite a challenge there. The PE fund not only comes in getting that merger and activity going on, but it also helps them in operational excellence. So that's where you identify what kind of transaction I can get in when you assess a deal. And the deal always needs to be assessed from a risk standpoint, from an allocation standpoint, and at the same time, it also needs to be aligned to capital versus consumer market, because usually these companies are either in either public companies or private companies.
And you mentioned risk. I think again, linking back to what we were talking about at the very beginning in terms of the healthcare sector, the antitrust involvement and so on. I want to lean into the kind of fourth and last topic of the day, which is um, kind of the politicization of today's deals, if that makes sense. There is clearly more eyes are pointed at the deals. We discussed about the antitrust, but then my question is, and I've read, a few news and a few pieces of information research where it seems like, there is more concerns around, for example, the ESG impact and the reputation that certain deals have. They might not happen just because there is an ESG implication. At the same time, if we look at defense-driven industries, there is a whole concern about the national security. So let's say if you are, even from a data perspective, really think about it, right? There is for cross-national and cross-border type of deals, there is a whole other consideration to do in terms of, okay, is this deal actually going to hurt the flow of data and information for the companies merged? So I guess, do you see a lot of these for real, or you think it's kind of a sense, but it's not really happening, and maybe there is more focus on actually making money rather than thinking of too much consequences, if that makes sense.
Yeah. So when you talk about those kind of categories, we in the risk management, we kindly label that into sensitivity versus relativity of that deal, basically, because there will be, if you talk about if you talk about relativity, definitely there is a continuity angle, even though you want an ambitious return, but their operational challenges would be something else from a portfolio company or a fund standpoint. So looking at what's the relativity, that's where the macro comes into play, is where you assess all the different types of risks, market risk, credit risk, and all those different risks for the portfolio company. And you also do that risk management at a fund level. Now, when it comes to investor obligations, getting them dividend and making sure that you always have that operating income going on. If there is another COVID, there is no operating income. So you need to liquidate the asset and then pay back the investor. So that is where you define sensitivity versus relativity. And sensitivity is more around those linkages of deep economic integration. For example, the real challenge between tariff between US and Canada, that is a sensitivity because it has to be followed up with a particular continuity factor and a transition factor. Yes, US has that ambitious energy plan and all of that, and those plans do require a certain continuity and transition indicators to build that reserve together, and then you have negotiations on the tariff and stuff. So that's what private equity does. It's not only creates the value for the investor, but at the same time it also creates that private market, capital market building through investment infusion into the companies, is where is you build that sustainable chain. So that's the key, is where how you understand sensitivity versus relativity of the portfolio. And it could be a single portfolio company, or it could be a full portfolio company, as you are into a co-investor or direct investment, whatever the type is. You enter into a fund, it will have certain value, and the certain value will have a series of risks coming into play.
I wanna, and there, like, okay, this is not really prepared per se as a question or as a thought, but because I'm receiving with the help of our LPGP staff and colleagues, I'm receiving some kind of summaries of questions that we are receiving live into the event. There is one of our participants that has been quite active, Tom Jensen. So thank you very much. I see all of you are sharing thoughts. But Tom's asked actually I think he's making a good point. And I just want to read you what he's saying, and then we can comment on that. Which is, speaking of the Apollo global takeover, yes, it's a big number, but scale doesn't always equal substance. Switching between equity and credit might service the financial model, and from an investor lens, it can look efficient. But I find myself wondering, where in that motion is the care for what the number holds, for the people, the systems, the stories behind the valuation? I think this is a very good kind of point. It's kind of a question, but also making a point. And I do agree, other than the ESG, regulatory risk, all the stuff that come from the playbooks. Like, what about the people? What about the, humans involved? What about the story of the company? Is this risk, in your opinion, factored in? Because it does represent also risk, right? Cultural risk.
Yeah, and coming to that Apollo itself, if you look at their portfolio, the reason why they do sensitivity relativity of the underlying products itself of the funds. It could be equity, credit, debt, derivative. Credit gives you a solid return, basically, because you have a very well repayment structure for a credit fund, and credit and insurance funds are the ones who drive actually very focused valuations, basically. So you know when that dividend is going to come, you know when the return, what kind of return you can expect. So basically, you get ratios, you get good ratios there, you get ranges, and you also get uh, the alignment with the markets as well when it's credit. Because when you look at a credit fund or an insurance fund, the first thing that you look at is correlation versus non-correlation from an economic alignment standpoint. And that's what gives you, hey, I could expect on a one quarter the return or the operating income is less, or it's going to be more based on those macro effects. But when it comes to equity, you just go into a series of uh, valuations. It's all based on how your net asset value works. So that is where I think Apollo's has got a very good return. So as ARK investment, it went to more than what, 130 or 140% a couple of years ago on return. So even that, the major factor was a product diversification, because ARK investment ended up building diversified ETF products in the market, which is a combination of both, the mutual funds and the hedge fund. That's the activity that goes into play. So it's all based on the product type, equity, debt, credit, derivative, and it also based on what fund you're getting into. Because if you go from a hedge fund standpoint, the cycle of a hedge fund is less than a year or two, or max of 3 years. But if you look at a private equity, it goes anywhere between 7 to 15 years, which is the largest patient fund. So that is how you look at and you structure those portfolios for your investors, based on that risk and based on that journey of the investor relations. Because every time there is a change, whether it's a clawback, whether it's a whether it's a drawdown, or whatever the other things that are in the term sheet, requires an extreme side letters, right? So that is where the legal comes into play. And I had an interesting session with one of the largest investment management company. They said we need a data model for each investor. It's not about that each deal, how the investor would like to accelerate their involvement through co-investments, direct investments, or whatever the other. Because if it's a pension fund, they come with their set of requirements as well. So to manage their requirements, there's so much data coming in, and there's so much in return that they need to maintain the accountability, transparency, and compliance, and regulatory aligned to those regulatory challenges as well, which is managing with the investment regulatories or monetary regulatories. So that is where maintaining that transparency and accountability. There are more systems coming into play. The data is now being very consistent and helping the funds to make those decisions.
Vinay, thank you very much. It was very insightful, a bit challenging for everyone at the beginning, but eventually we made it there, which is great. And I really, really look forward. Just to inform our audience as well, if you enjoy this talk, we are, as I mentioned at the beginning, we will have a weekly catch up, either on Thursday or Friday. We're still adapting, trying to understand, what is the best day for everyone. But for sure, we're gonna have Vinay once per month. So there is gonna be another set of events. We're gonna go and dissect, of course, private credits, operators' points of view, and much more between now and the end of year. So thank you, Vinay, for joining us.
Thank you, Andrea. And I think I really appreciate the slides that you're providing part of these conversations that brings a lot of value. And at the same time, you're able to bring whoever on the call to these discussions, and they can always drop an email to LPGP. We will be definitely post answer those questions as well.
They can also find our LinkedIn profiles and our pages, LPGP, Impact Fundry, Cognitive Academy, and Global Economist, linked to the event. So by all means, make sure you follow us across our social media. Vinay, I'm gonna praise your content because I do believe it's very interesting, and it's very important to follow people that can always bring new ideas and new context to their world we live in. Thank you, everyone. Enjoy your weekend wherever you are. I hope it's sunny and it's hot, and make the most of it. And we will see you next week. Stay tuned and goodbye.